Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello and welcome to the latest instalment of our Through the Noise mini-series to discuss our Q2 outlook, Staying Safe. Today I want to talk in a little bit more detail about our bond market outlook. Now, we remain overweight on bonds, especially investment grade or high quality bonds, as we get more and more concerned about the risk of a recession in the developed markets, especially the US and Europe. To explore the implications of this for global bond markets, I have with me Abhilash Narayan. So, Abhilash, let's dive right in. As I mentioned before, we're overweight on bonds. What are the key factors underpinning the strong conviction here? And has there been any change in your thinking since the start of the year?
Hello, Steve. The key driver for our overweight call on bonds is the rising risk of recession, which remains largely unchanged compared to start of the year. Now, as my colleague Rajat would have highlighted in an earlier podcast, if anything, the risk of a recession has marginally increased in our assessment. Most of our US recession indicators, except for two market based gauges, equity and credit market indicators, most of the other indicators are flashing warning signals that a recession is coming. Now, while we expect the Fed to hike rates one more time before June, we think that the softening economic indicators and tightening financial conditions indicate that the Fed rate hiking cycle is coming close to its end. In fact, while the Fed does not expect to cut rates this year, we believe the slowdown in growth will force the Fed to cut rates towards later part of the year, driving 10-year US government bond yields lower. And as we know, lower bond yields usually equate to higher bond prices. Now, within bonds, we maintain our conviction and our overweight stance towards Asian US dollar bonds, and we remain underweight on developed market high yield bonds. Now, the one key change is that we have upgraded developed market investment grade government bonds to an overweight.
Okay, so let's continue on that theme. So we have a preference for the most defensive part of the bond market. Can you elaborate more on the thought process there?
Given the heightened recession risk, we think that the risk reward for developed market investment grade government bonds has improved at the margin. Now, we believe that the recent US regional banking sector turmoil has actually exerted additional pressure on the already fragile economic outlook, as banks are likely to tighten their lending standards to preserve capital, increasing the risk of a growth slowdown. Historically, developed market investment grade government bonds is an asset class that has benefited from falling yields around the peak in Fed rate hiking cycle. So we think that the demand for safe haven assets as recession risks rise and potential Fed rate cuts towards later part of the year should drive yields lower. In fact, we have revised our end 2023 expectation of 10-year US government bond yields lower from around 3.25% towards 2.75 to 3% range. So, not only are these bonds a good hedge against the recession risk, but in our assessment, the potential upside has marginally increased for these bonds.
Okay, so what about investment grade corporate bonds in the developed world? Do we like them as well?
We are actually neutral on developed market investment grade corporate bonds, though I admit the yield of over 5% does look attractive. But when we think about corporate bonds from the developed world, while the average credit quality for these bonds is high, we see rising risk of a ratings downgrade cycle as corporate funding costs climb, driven by higher Fed rates and tighter lending standards across US and Europe. Secondly, we think that the current yield premiums or credit spreads are fair at best, and they don't provide a lot of buffer for potential credit deterioration should a recession materialize.
Okay, so let's come closer to home and look at Asia. So you mentioned that you remain bullish on Asian US dollar bonds. What are the key drivers for that view?
Sure, Steve. Now, as we've previously discussed on this podcast, Chinese issuers are a big component of Asian dollar bond index, accounting for nearly half of the total bonds in that space. Since the release of our 2023 outlook, we have seen a faster than expected reopening of China, and China's GDP growth expectations are being continuously revised higher by various market analysts. So, the improved growth prospects should lead to better corporate earnings for Chinese issuers, which is clearly a positive for Asian US dollar bonds. Now, in addition to that, a vast majority, approximately 85% of Asian dollar bonds are investment grade rated, which we believe provides a strong shelter in terms of credit fundamentals should we see a recession in US and Europe. Now, this sub asset class does admittedly have low interest rate sensitivity, which means that it is likely to enjoy less capital appreciation should our view of lower US government bond yields materialize. But we think that the yield premium that the asset class offers, approximately 300 basis points, is attractive and does offer genuine value. So we remain overweight on Asian dollar bonds, and within Asia as well, we do have a preference for investment grade bonds compared to high yield bonds.
Okay, so what about the rest of emerging markets? I see you have a neutral stance on EM, US dollar, and local currency denominated government bonds. Why aren't we more optimistic there, especially given the weak dollar outlook?
You make a valid point, Steve. Clearly, China's improved growth prospects do raise the question about whether the broader emerging markets would benefit from that, given that they are net commodity exporters. And in addition to that, the weaker US dollar is generally considered to be a tailwind for emerging markets. But if we zoom in on commodity prices, while prices have normalized, we do not see substantial upside for them, given that China is focused on a consumption-driven recovery, and commodity prices also face the overhang of potentially lower demand from US as well as Europe. Now, if you look specifically at emerging market dollar denominated government bonds, while they do offer relatively high credit spreads compared to their own history, when we look at the credit quality, that has clearly deteriorated over the past few years, and we are seeing signs of stress showing up in multiple countries, especially the low rated countries. Hence, we think that the risk reward there is balanced despite the optically high yields on offer. If we shift our focus to local currency bonds, we see more room for flexibility for EM central banks. In fact, money markets are currently expecting majority of the EM central banks to take more active role in cutting policy rates over the next 12 months. While that is clearly a positive from a domestic bond performance perspective, that will lead to lower interest rate differentials for various EM countries relative to US, and that could mean that emerging market currency or the FX component could remain volatile. So we think that the risk reward there is balanced at the best.
Okay, maybe just one last question squeeze in at the end. So we have a cautious stance on developed market high yield corporate bonds. Can you give us a sense of why that view's in place?
Absolutely. Now, from a fundamental perspective, the key risk to developed market high yield bonds is the likelihood of a recession in US. Admittedly, nominal yields look quite attractive, particularly after the recent rise we have seen. But despite the attractive yield, we think that it does not make sense to add further exposure to this bond sub-asset class, because we know for a fact that historically, whenever we've seen recessions happen, default rates tend to rise around that point. Given that economic growth slows down and lending standards tighten. And in fact, we are seeing both of these conditions play out at the moment as well. And clearly, there is a price for every asset class out there. But with credit spreads being broadly in line with historical averages at the moment, we think that the asset class poorly compensates investors for the risks at hand.
Okay, well, thank you so much, Abhilash, for your insights. Obviously, it's a very important area of the market. Bonds are our favoured asset class at the moment, so it's really interesting to hear your thoughts. Thank you, listener, for joining us. I hope you found it useful as you continue on your investment journey. Should you need more information, please do not hesitate to take a look at our Standard Chartered Wealth Insights page on LinkedIn or Facebook. I will be back with Manpreet tomorrow to talk about the currency market outlook. I look forward to talking to you then.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.